Welcome to Iron Financial. Today, we're forging deep into the financials of Webtoon Entertainment, ticker WBTN. Now, on the surface, this company just posted an earnings beat. I mean, it was a positive surprise that, in a normal world, should have sent the stock rocketing upwards. But that's not what happened. Not even close. The market reacted like it spotted a massive structural crack in the company's foundation, sending the stock into an absolute free fall. So we're here to do what we always do. Cut through all that noise, stress test the structure, and find out what's really going on. Is this company built to last on a foundation of iron, or is this just a fancy facade built on a pile of sand?
Okay, let's dive right into this, because this is the number that kicked everything off. The headline numbers, the ones that flash across every trading terminal and news site, they looked really solid. Wall Street analysts, the so-called experts, were all lined up expecting Webtoon to lose 15 cents for every single share out there. But instead, the company comes in right at break-even, 0. Now, from a pure top-line numbers perspective, that is a clear, unambiguous beat. No question about it. They didn't just scrape by and meet expectations, they blew right past them. I mean, this is the exact kind of report that management teams dream of releasing.
A beat, sure. The trading algorithms probably love that headline for, 5 seconds? But if the news was so good, if this was such a stellar, expectation-crushing report, then you have got to explain this slide to me. The stock didn't just dip. It didn't see some light, healthy profit-taking. It cratered, a nearly 13% drop in value. That's not a pullback, my friends. That's a panic button. The market, which is the collective wisdom of thousands of investors putting real money on the line, is screaming at the top of its lungs that something is deeply, fundamentally broken here. So the question for us is pretty simple. Is that headline just a bunch of hype, or is the reality a dangerous trap for any investor who dares to step in?
And that is the core question we are going to hammer out today. We are going to break this company down piece by piece and stress test every single component to see what holds up. We're going to start with the numbers that look good on the surface, the supposed strengths, before we start digging into these serious structural weaknesses that the professional market obviously sniffed out. So let's get started and see how this story builds, beginning with that contradiction itself.
So what we have here is a classic Wall Street mystery. A company reports that it did better than expected by a country mile, but the professional investors, the folks who manage billions of dollars, they run for the exits like the building is on fire. This is the exact kind of situation that separates the amateurs, who just skim the headlines, from the pros, who read every single footnote. Look, anyone can see an earnings beat. The real money, the real insight, is made by understanding why the market chose to completely ignore it. So it's time to roll up our sleeves and do some of that heavy lifting.
All right, let's start where any good analysis should, the foundation. Any structure, I don't care if it's a skyscraper downtown or a company's stock price, is only as good as the base it's built on. You can have the most beautiful design in the world, but if that foundation is weak, the whole thing is worthless. And on paper, if you just look at the assets and liabilities, Webtoon's balance sheet looks like an absolute fortress. Seriously, it looks like it's been constructed out of solid reinforced steel.
I mean, what's really striking on this slide is the sheer, overwhelming financial strength staring you in the face. Just look at these numbers. Cash and cash equivalents of over $500 million. That is a massive war chest they're sitting on. Now, look at the debt column. 0. That's right. Not low debt, not what you'd call manageable debt. 0. None. Their debt-to-equity ratio is a minuscule 0.02, which for all practical purposes is nothing. And then you look at their current ratio, 2.52. That means for every single dollar they owe in the next 12 months, they have $2.52 in easily accessible assets to cover it. The crucial point here is this. This company is not going bankrupt tomorrow or next month or probably even next year. This is, by definition, a financial fortress.
Okay. A fortress is great, I get it. But a fortress with no one defending it, no commerce happening inside its walls, and a facade that's starting to crumble, that's not a fortress, that's just a museum. It's a relic of a bygone era. That cash pile is undeniably impressive, I'll give you that, but cash doesn't generate a return just by sitting in a bank account. It doesn't mean the business itself is healthy, and more importantly, it doesn't mean the business is growing. So here's the real question. Is this $500 million pile of cash a war chest that they're going to use for smart strategic acquisitions and aggressive growth? Or is it just what's left over from their IPO, slowly being burned away by a core business that's running full speed into a brick wall?
And that is the perfect transition, because that's exactly where the first major cracks start to appear in this whole structure. See, the balance sheet, that tells us about the company's stability in its past decisions. It's a snapshot in time. But the income statement, that tells us about the present, and it gives us some really important clues about the future. And right now, Webtoon's present is looking alarmingly weak. This is the part of the story where things start to turn ugly.
Just look at this chart. For the entire year, revenue was up a measly 2.5%. Now, for a company that's supposed to be in a high-growth industry like digital media and entertainment, that's practically stagnant. That is the kind of growth you'd expect from a boring old utility company, not a disruptive tech platform. But the real alarm bell, the siren that probably sent institutional investors sprinting for the door, is the most recent quarter, Q4. Revenue didn't just slow down, it went into reverse. It dropped over 6% year over year. Folks, this isn't just a slowdown, it's a full-blown reversal. The growth engine isn't just sputtering, it is completely stalled out and is now rolling backward down a very steep hill.
Okay, so a single bad quarter can happen. I get it. Maybe a big deal got pushed into the next quarter, maybe there was some kind of one-time issue, fine. But a strong management team comes out, they explain the problem clearly, and then they give a confident outlook. They tell their investors exactly how they're going to turn the ship around. So what did they tell investors to expect next? Is there a recovery on the horizon? Because that's what a durable, ironclad company does. It identifies problems, and then it fixes them.
From it, their guidance for the next quarter, Q1 of 2026, was an absolute bombshell. They are guiding for revenue somewhere between $317 and $327 million. Let's just take the midpoint of that range, $322 million. Wall Street was expecting over $350 million. This isn't a small miss. This isn't a rounding error. This is a massive 8% shortfall from what the consensus was forecasting. Management is explicitly telling the market that the weakness they just showed wasn't a fluke. It's the new reality. They are signaling that the decline isn't just continuing, it might even be accelerating.
You know, slowing growth is one thing. And believe me, it's a serious problem. But with that fortress balance sheet we talked about, $500 million in cash and absolutely no debt, surely they're making money, right? The core business must be profitable. At the end of the day, that is the real test of a business. It's not about how much revenue you bring in through the front door, it's about how much cash you actually keep. So what does the bottom line, the real profit, actually look like? Well, that's what the CEO, Jung-Koo Kim, wants you to believe. They put this quote right at the very top of their earnings press release, front and center for everyone to see. Third consecutive year of growth and profitability. He's trying to build a narrative of strength, of consistency. But this is where the real work comes in. This is where you have to read the fine print, because that word, profitability, is doing a whole lot of heavy lifting in that sentence. And there it is, the magic of adjusted profits. This is a classic management trick, and you see it absolutely everywhere. They're not talking about real, by-the-books, generally accepted accounting principles profit. Nope, they're talking about adjusted EBITDA. That's earnings before interest, taxes, depreciation, and amortization, with a few other very convenient costs stripped out for good measure. It's a fantasy number that conveniently ignores a lot of very real, very cash-based expenses. So what is the real number, the one that the accountants actually have to sign off on, have to say?
The real story is a complete and utter bloodbath. This isn't profitability. For the full year of 2025, Webtoon didn't make a dime. They lost over $373 million. Let that sink in. This isn't some small loss you can explain away with a few excuses. It's a staggering black hole on the income statement. And to put that into perspective for you, their net loss in the fourth quarter alone was $336.5 million. That's more than double the loss they posted for the entire year of 2024. This isn't profitability, this is a financial inferno.
So how in the world do you lose that much money that quickly? I mean, that's a breathtaking number. The company's press release blames something called goodwill impairments. Now that sounds like some boring technical accounting term that most people would just gloss right over. But it is not. It's a huge flashing red flag. So what exactly is a goodwill impairment in plain English, and why does it matter so much?
Exactly. It's the polar opposite of boring. It's a confession. See, goodwill is this intangible asset that gets created when you buy another company for more than its physical assets are worth. You're basically paying for its brand, its reputation. An impairment charge means that management is now officially telling the market and the SEC, we messed up. We made a big acquisition in the past, we overpaid for it, and this thing we bought is not worth what we thought it was. It is a direct, painful hit to the credibility of management's entire strategy for allocating capital. So the crucial point here is the loss isn't just a number, it's a public admission of a massive strategic failure.
Okay, so the core financial structure is a complete mess. The growth story is broken, and they're basically lighting money on fire. But what about the headlines? What about the narrative?
I keep hearing about these massive, splashy deals with industry giants like Disney and Warner Brothers. Isn't that the bull case? That even if the core business is struggling, they're becoming the go-to story engine for all of Hollywood. Can that kind of hype save them?
And that is the exact narrative they are pushing. And believe me, they are pushing it hard. On their earnings calls, in their press releases, they are constantly highlighting these partnerships as proof of their long-term potential and the incredible value of their intellectual property. And this is where you see the massive, glaring disconnect between the story management wants to tell and the financial reality the company's actually living.
Hold on. So let me get this straight. While they're out there announcing these huge, game-changing partnerships, the actual money they make from turning their IP into movies, TV shows, and other things is going down. The revenue they get from advertising to their supposedly dominant and loyal Gen Z user base is also going down. The hype is not translating into dollars. In fact, the numbers are moving in the complete opposite direction of the headlines. It looks less like a long-term growth strategy and more like a desperate attempt to distract everyone from the fact that the core business is bleeding out.
All right, so it's time to put it all together. We have to weigh all the evidence and render a final verdict. We've examined the foundation, which looked incredibly strong at first glance. We've found the deep, structural cracks in the growth story, and we've seen the massive profitability black hole that's just burning cash in the basement. So let's lay out the final arguments, bull versus bear. The bull case, the argument for buying this stock right now, is actually pretty simple, and it really rests on a story. The story is that they have the cash to weather any storm, so they have time to figure things out. And their library of content is valuable enough to attract giants like Disney and Warner Brothers. The hope, the prayer really, is that these deals will eventually pay off big. The bear case, however, is rooted in the cold, hard numbers of today. The core business is deteriorating at an alarming rate. They are not profitable by any real, honest measure, and management is publicly admitting that their past strategic decisions were total failures. To top it all off, their own guidance confirms the pain is far from over.
So, our verdict is this. This is not a buying opportunity created by a simple market overreaction. This is the market correctly identifying a deeply flawed business model whose best days may very well be in the rearview mirror. That initial earnings beat was a complete head fake. It was a distraction from the crumbling structure underneath. The real story here is a company in rapid decline, and that huge stock drop was a perfectly rational response to a disastrous outlook and a public confession of past failures. The foundation is not made of iron, it's made of sand.
And that is the multi-million-dollar question, isn't it? But right now, all the evidence we've looked at points to no. They are burning through their safety net without fixing the fundamental leaks in the business. The clock is ticking and the sand is shifting beneath their feet. Thanks for joining us on Iron Financial, where we cut through the weakness to help you forge a stronger portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.